Welcome to our YouTube channel, BitToAlt. Today we will be discussing an important topic: the cryptocurrency crash. Please click on the subscribe button of our track and hit on the bell icon so that you get a notification whenever we put up a new video. Now, without further ado, let us jump into the topic and try to analyze the situation with cryptocurrencies. The cryptocurrency market has had a difficult start to the year. They have performed very poorly and lost a lot of value due to the crypto crash. Ethereum, ETH, and Binance Coin, BNB, had lost nearly 30% and 25%, respectively, and Bitcoin has lost 20% in value, despite a late run upward. These are the top 3 cryptocurrencies by market capitalization, excluding the stablecoin Tether linked to the US dollar. This is not the only time cryptocurrency has decreased rapidly in value, and they had crashes previously. Cryptos had another significant slump from May to July in 2021, with Bitcoin plummeting more than 45%. Despite their inherent instability in them, many investors remain enthusiastic about cryptocurrencies. Investors might be interested in knowing what to do and what actions to take so that they don't get hit by further falls in the values of the cryptocurrencies. We will talk about 6 possible reasons why the cryptocurrency crash happens. 1. Crypto market have less liquidity than traditional financial markets. The general cash flow of the needs is the most significant issue that the crypto markets face when leveraged investors sell off a considerable amount of their assets. Unlike the average stock market, there isn't a swarm of buyers eager to purchase unsold cryptos. When many crypto coins are sold, fewer investors are interested in purchasing cryptocurrencies. This is why large institutions cannot trade cryptocurrencies because of the lack of liquidity in the market. They eventually made the market crash. For example, when a whale, an investor with a substantial holding in any particular asset, sells enormous sums of cryptocurrency, it might just flood the market. The coin's supply increases in the market, leaving a vast supply with very little demand. This availability of cryptocurrencies causes a market crash because there is fear among the crypto holders who wish to sell off whatever they have and cover their losses. So, we see lack of liquidity in cryptocurrencies is a big issue now. 2. There is a fear of crypto security breaches. Other variables that might create a crypto meltdown are blockchain and network security. This type of disaster would play out similarly to regulatory interruptions, which the government actors cause. For example, if it looked that Bitcoin had a security issue, it would reduce the motivation to mine it, thereby affecting the hash rate and the total price. In addition to that, unlike stocks, which are underpinned by tangible assets, the value of most cryptocurrencies is solely determined by market emotion and investor sentiments. According to Dan Kemp, the global chief investment officer at the Morningstar investment management firm, the issue for investors who want to own cryptocurrencies is to locate those with limited supply and a very long-term appeal. So, we can see that the security issues of cryptocurrencies are a significant factor that might cause a cryptocurrency market crash. Cryptos have a domino effect, and the others also begin to crash one after the other when one hits them. 3. Correlations between cryptocurrency and the stock market. The fact that crypto should be an uncorrelated asset is part of its allure to the investors. In other words, it should be free to float independently of the rest of the market. This means that stock market behavior, highs and lows, bull runs, and bear phases should have nothing to do with cryptocurrencies. They will behave as a unit of their own. However, this is not always the case. Due to its acceptance by stock market players, crypto markets have been behaving in tandem with traditional stock markets in recent years. According to some, cryptocurrency has a high association with the stock market. As a result, the world's newest hedge against interest rates and inflation may be more tied to global markets than early users anticipated. However, many crypto and market experts believe that crypto collapses are a part of investing in crypto. Every asset has its crashes and rallies, which is part of investing. Investors must evaluate their time horizon for keeping digital assets and their ability to withstand market downturns. 4. When government tried to regulate cryptocurrency, when China prohibited cryptocurrency mining, the miners were forced to relocate to more miner-friendly nations. There was a considerable fall in the network hash rate. A hash rate is the number of calculations completed per second in the crypto industry. These computations enable miners to manufacture the coins they are mining and influence the price of a cryptocurrency. The hash rates also go down when the prices fall. It's been argued that the contrary is also true. This is frequently because miners get compensated in cryptocurrencies. However, when governments restrict mining through legislation, the overall cost of cryptos may fall. This was an example of the rules laid out by the Chinese government. However, this can happen with governments of any nation. 5. Cryptocurrencies are volatile by nature. Even the most ardent crypto supporters will tell you that success in the crypto sector is far from certain. Its volatility is part of what draws many speculators to the possibility of making money far faster than traditional stock investing. However, the promise of the boom is accompanied by the natural potential of the bust. As we say, the thing has its good and bad sides. Since the birth of Bitcoin in 2009, there have been multiple big bear and bull cycles in Bitcoin and other cryptocurrencies, with short-term speculators filling the market and then abandoning it. Many exchanges, particularly during boom periods, provide fundamentally dangerous ideas that allow traders to invest with borrowed cryptocurrency, meaning they are leveraged if prices begin to fall. Whether as a result of large investors selling their shares or for other reasons, a lack of actual cash flow can contribute to substantial crypto crashes. 6. Fears of a recession and inflation after interest rate hike. According to experts, the recent crypto market meltdown is caused by panic about inflation and worries of a looming recession. When the Federal Reserve stated that 0.5% will raise interest rates, Bitcoin saw a temporary relief rally, reaching $40,000. This enthusiasm did not last long, as market investors began to fear inflation and a probable recession, causing stocks and cryptocurrency markets to plummet. A dramatic decline in the sentiment and mood of the stock market ended in Bitcoin trading at around $34,000, ETH fell to $2,527, and in general, the crypto market started crashing. The Crypto Fear and Greed Index, which measures market mood, is currently at severe fear. That's it from our side. If you find the video useful, don't forget to like and subscribe to our channel.